As promised, one of India's most respected market voices, Mihir Vora, he's Director and Chief Investment Officer at Max Life Insurance, joins us. Thank you so much for joining us, Mr. Vora. You had actually in August kind of told our viewers that be prepared for a sideways correction, and that actually played out. That played out and it has happened. Now, what is your sense on the overall markets? Is it going to go down from here, or have we had that sideways correction and gone down as much as we had to, and now it's going to resume that upward trend?
Good morning, always a pleasure. I think we are still in that zone, given the fact that the market move from the lows of Jan-Feb has been really sharp. We also see the situation wherein the private sector capital expenditure has shown no signs of improving, while government expenditure on the roads and other infrastructure projects continues. The only bright spot we can see in the next couple of months is the rural and urban consumption, which should be holding up because of the better than expected end to the monsoon, and the fact that we now have the arrears of the 7th pay commission being rolled out, being distributed by the government. So I think it's going to be a situation in which some of the market earnings results may not be that great. So overall market earnings are likely to be single digits for the quarter ended September, but there will be pockets of growth, which probably will be the theme going forward.
Okay. Before I proceed in terms of looking at the individual stocks, and I know you can't talk stocks, but there are some data which is published on your website in terms of the portfolio of your various funds which are there. But let me just get the macro issues out of the way. And as you said, that 7th pay commission, rural growth, these are going to drive consumption. There's an interesting thing that I was talking to our .com side, and they were saying that any story which has to do with 7th pay commission, any movement on the 7th pay commission gets huge number of hits. And it's almost as if no one's interested in anything else. So I was asking them, what about Pakistan? And said 7th pay commission news beats everything hollow. It seems to be that there is a degree of anxiety about how much is going to come through. And it's still not clear whether the money that they were expecting has actually come through.
Yeah, so it's not going to be in 1 month or 1 quarter. It obviously is going to be a staggered impact, and individuals and families will also have different priorities. Some of them might going for consumer durables. A lot of them, I'm sure, will go in for property, etc. So the whole bunch of money that we are going to get over the next few quarters is likely to be spread out across a lot of assets and consumption. But overall, it's a decent number, the overall size of the stimulus that we are talking about. So it should have a stimulatory impact on the overall economy, especially coming on a base that has been not great for the last couple of years. It is a welcome addition to the consumption story.
Mr. Vora, I'm sure you would have watched it, closely scrutinized all the minutes that were released of the MPC yesterday. And the headline seems to be that the MPC believes that we are on the uptrend. Economy, the revival is visible. But when you actually read the fine print, it almost seems almost every member said that we are not seeing any recovery. So except for one member, almost everyone said there's no recovery in sight. Which side are you on? What are you seeing on the ground?
So as I mentioned in the initial comments, the only a couple of bright spots probably are the fact that the government has been quite aggressive in executing its infrastructure thrust. So basically the plan expenditure, the capital expenditure, which is in the hands of the government to the extent possible, the government has been executing, and they've also rolled out a whole slew of newer projects which should continue the government spending momentum over the next few years. For example, we are talking about fresh airports. There is a huge thrust on inland waterways. So these are massive activities which will continue to make sure that the government part of the capital expenditure cycle continues for the next few years. and as we mentioned, we should see some bright spots in consumption. But the business sentiment, I would say, the private sector capital expenditure, the private sector investment just has not turned. Now whether it's because of lack of perceived demand or whether it's because of lack of resources in the private sector is a thing to debate. I would say it's a combination of both, but the bottom line remains that capital expenditure cycle from the private sector is still not happening.
All right, let me now come to your own investing style and the way in which, and of course you're constrained by the fact that you're investing insurance money, so they're long-term in nature, but you do have some funds which are growth, super growth. How do you distinguish between these funds in terms of how you invest, the proportion that you invest?
Sure. So the funds that you mentioned are our unit-linked funds, which are more, I would say, investment vehicles, and the asset allocation broadly follows the pattern which was designed as per the product characteristics. So we have a whole range of funds from 100% equity funds to 100% fixed income funds, and the broad asset allocation is in line with the product characteristics. So while there is a range for each of them, broadly speaking, the products are, a balanced fund or a pure equity fund or a pure debt fund, that kind of a range that we mentioned. So asset allocation calls is something that is constrained by the product characteristics, but within that, of course, we do the appropriate sector and stock selection.
Okay, let me take something like the growth super fund, which if I look at your website, I don't know how, I think it's updated to July. It tells us that from inception, from the point at which you started these funds, I think the growth super has performed the best, at least till July. And when I go into the portfolio, and then I look at the year to date, they've actually underperformed the index. So sometimes are you tempted as an investor, as a person who actually oversees the investment, to go with the flow, or do you just stick to your belief that the long term, these are the companies which are going to do well? So individual years don't matter.
So we tend to look at a time horizon typically of 1 year and 3 years. So the longer term for us in these kind of funds would be 3 years and beyond. And the intermediate term that we typically look at is 1 year. And below 1 year, we believe that it's difficult to predict the volatility in the market and the stock prices, etc. So the calls that we typically take are for a minimum period of 1 year.
All right. So again, when I look at Growth Super, for instance, from inception, it's your best performing fund, as I can make out, beats the benchmark index quite significantly. If I look at previous calendar year, it beat the benchmark index by 3.5%, which is a very decent return on an insurance-linked fund. But this year, it's underperforming. And when I look at the portfolio, and this is where I don't know whether you are at liberty to disclose it, I look at it, it's a pretty conservative, big cap oriented fund, right? And there the biggest exposure is to Infosys. Are you still sticking to IT as a long-term growth, or has your bet changed since July when it was published?
Sure. So the fund that we are talking about is a pure equity fund. Basically, normally 90% plus of the asset allocation is in equities. And the broad call on the IT sector that we have has been underweight for quite some time. So while you do see large IT stocks in the top holdings, that's also a function of relative benchmarking. These are large weights in the sector as individual stocks. So while we are significantly underweight on the sector per se, some of the large stocks do show up in the top holdings because of the large default weight that they have in the benchmark. In our case, the benchmark is the Nifty 50, so to say. But I would say that I've said this on many forums earlier also, that IT as a sector is a sector typically you would like to be in when you're uncertain about the markets, when you want to run away from volatility and not being greedy about growth. But when we are looking at a situation in which we are seeing a slow domestic growth recovery, this is not a sector to be in, because we do believe that it's a sector with a top line growth of 10 to 12% at the max, and the large companies can probably go a little more than that, not too much more than that. So if we want pockets or segments where you want 20, 25%, 30% kind of a growth, probably this is not the sector to be in. So it's a sector with very high quality companies very high ROE, ROCE, very high cash flow generation companies, very well managed companies. But the structural issue with the sector is that growth has slowed down because of the size.
But at what kind of valuations would you buy that stock? I mean, not one stock, but any of these stocks.
Sure. So as I said, the valuations broadly for the sector that we see currently are very reasonable because stocks have underperformed for quite some time. So these are not levels at which one would be, short on the stocks, or one would be going extra underweight on the stocks. We would continue to run the positions, which is that of underweight position, but not kind of go further underweight from these levels.
So if I look at, for instance, in the Nifty, the weight of, if I take Infosys, TCS, Wipro, HCL Tech, the total weight is about 14.5%. And when I look at the July published data that you have out here, you're about 13% in your growth super fund. So it's not dramatically underweight yet, right? Or have you changed that over the last 3 months?
Incrementally, we have shifted positions. We are more underweight than that now.
Okay. So which way has it gone? Has it gone into auto? Has it gone into financials?
Yes, mostly in the private sector financials and consumer discretionary, which is pretty much autos. You're right about that.
All right. And obviously,
essentially, as I said, we are more playing the domestic sectors compared to the international sectors, exporting sectors like IT and pharma, because we are looking at a recovery in the consumption theme. We are looking at slow recovery or rather a continuation of the government spending. So pretty much we are happier sticking to the domestic sectors rather than export or international sectors.
So within that, I see that financials, as you said, private sector financials and auto is a big space. What about cement? You do have some exposure that I can see, and perhaps slightly overweight there as well?
Yes, cement is a slight overweight. However, we do think that valuations are not that great anymore. So while we've enjoyed some upside in the sector for some time now, this is not probably the valuations at which we would go further overweight, I would say.
For a fund like the funds that you have, and also overall the payouts that you have to do, how often do you have to actually pay out money? How often is it that you need to generate cash to pay out?
And, in the structure of the products that we have, not very frequently. We have a fairly stable corpus for a long period of time.
So how often do you need to invest? I mean, obviously when you have fund flows, you invest. The additional fund flows that come in, do you tend to invest more or less in the same stocks, or are you always trying to look at new ideas?
So the corpus does not change dramatically on a month-on-month basis. Typically, our premiums come towards the end of the month, and you might have to do a little bit of small rebalancing, but not dramatic. So we don't see dramatic inflows or outflows in the fund on a month-on-month basis. So you pretty much stick to your positions and keep taking tactical calls, probably more based on the asset allocation and the weightages that you want to adjust. It's not a function of inflows and outflows, I would say. It's a function of the tactical allocation which we are doing on a day-to-day basis.
Okay. When I look at your portfolio again, and this is a July portfolio, I have to warn our viewers that Mr. Vora has, because of compliance issues, cannot tell us stocks. But I'm looking at the July portfolio, and I'm assuming that you would be more or less invested in them, even if you've changed the breakup there. You seem to be investing a bit on short cycle infrastructure as well, which is things which are required on a more regular basis. Is that a correct call? Short cycle infrastructure, construction, because I can see PNC, Infratech there, Sadbhav Engineering, a lot of things which were not perhaps favorites for some time.
So these, as I said, we are looking at pockets where we have visibility of growth. And as I mentioned earlier also, the government spending part of it seems to be very consistent, both at the central level, at the state levels. And road projects is something which is rolling out quite nicely. We are seeing more than 20 kilometers of road being rolled out every day. So a lot of the stocks that you did mention are in that segment. And that's a segment where we do see continuous visibility. And we are happy to hold it going forward. we've been in this segment for quite some time, and we are maintaining our positions in that.
Okay. When we've seen a lot of new IPOs come in, and most of them have come actually post-July. Have you been investing in them? Have you found some of them interesting?
Yes, we have been participating in the IPOs. However, the good ones, as you know, get oversubscribed so much that you end up getting a small portion of the allocation. So it doesn't move the needle as far as the overall fund performance goes too much.
And once that happens, do you sit on it for the prices to correct and come down? Because usually what we see is that the IPO lists at a bit of a discount, then goes up and probably becomes the price becomes out of whack for some time. But do you wait to increase your exposure in that?
Yes. So when we look at a stock, obviously we do see some upside on listing. And if the listing happens at a price which is still below that upside that we see, we'll probably go out and add to that holding.
All right, Mr. Vora, in terms of an investment philosophy, obviously you've had many roles in your career. But when you are actually in an insurance, the monies under you are essentially insurance money coming in or unit-linked plans. How does it change? Are you top-down? Do you become bottom-up? From bottom-up, do you tend to be top-down? Does the future of the economy become more important?
So, see, the point is that any stock pick that you do, always, in my view, always is a combination of a view that you take on the top-down basis, which is economy, sector, etc., global, local sector views. So that's the top-down part of it. And there is no choice but to do a bottom-up analysis of the stock also. So you have to meet the company, you have to understand the business model, you have to gain confidence in the management's capability, credibility, etc. So every stock pick that you do is always a combination of a top-down view that you have on that particular country or that particular sector, which are also linked, and also a combination of macro factors. For example, if you are studying a stock in the IT sector, do you have a choice but to have some view on the US economy? You don't. You have to have some view on the US economy, some view on US corporate spending on IT, etc. So it's never a simple case of top down or bottom up. In my view, it's always a combination. The good thing about the insurance corpus that we run is that the money is very stable. We are not worried too much about day-to-day outflows, redemptions, etc., because the premium typically keeps coming on a annual renewal basis. So to that extent, we can deal with situations, and we can take longer term calls on the stocks and sectors that we do.
Okay. How hard is it to find stocks when you actually look at them bottom up? Because I did a small exercise that I identified the top 20 funds, and I worked out the number of the entire basket of stocks that they invest in, and I found that the number was 178, and I think 2 months ago it was about 173. 5 new stocks have been added. 4 out of them were IPOs. So in a country which has about 4,000 listed stocks, about 1,200 actively traded stocks, just 178 odd and perhaps 200 make up the entire basket of stocks that most fund managers or big investors seem to invest in.
Sure. So I assume you're talking about the large sized funds that you would have studied, right? Yeah.
Right. And in fact, I did take up
exactly.
the small cap. I did take up 2 small cap funds as well. So it's not just, one fund had a corpus asset under management of 120 crores, because otherwise I wasn't be able to actually incorporate the small cap. So I did take 2 small cap funds.
Sure. So the thing is that typically, fund houses or insurance companies have, team sizes which are probably, depending on the corpus, depending on the number of funds that you run. But I would say anywhere between say 15 to 30 people on the equities side or the total investments side. So one, there is bandwidth issues obviously. Second is there is also liquidity issues. If you look at the trading pattern in the markets, beyond the top 20, 30, 40 stocks, the trading volumes also becomes an issue, impact cost becomes an issue. Market cap restrictions also would tend to, from the prudence point of view, make limitations on the amount of stock that you can own. So for example, let's look at a fund which is say 10,000 crores in corpus, one fund. If it looks at a company which is say 3,000 crores in market cap, and there are not many companies beyond 3,000 crores in market cap if you look at the total filter. If the fund wants to put 0.5% of its corpus in a stock, it means that the fund needs to buy probably at least 50 crores worth of stock. So we are talking about 50 crores of a 3,000 crore company. So it's probably 1.5 to 2% of the company just for a 0.5% holding in the fund. So that's a trade-off. If you see a 300% upside in the stock, probably it's worth the effort to go and buy 50 crores worth of that stock. But if you're saying 30% upside in the stock, it may not be worth the effort.
Okay, so if you were not investing in someone else's money, like insurance money, and as you said that 0.5% means 50 crores, and that's almost, and if it's a 300 crore company, that 2% becomes 20%. You almost have to become the owner of that company, right? So if you weren't doing it and you were just investing your own money, would you actually look at growth? Would you look at smaller companies, things which your own fund constraints stop you from looking at?
So that's what I would say a lot of the the discretionary portfolio management schemes are doing these days, trying to enter into the space where probably the large funds have not gotten into. And in a country like India, there is always newer segments, newer sectors, newer stocks coming up. It's a very thriving market, it's a very dynamic market. And if you look at the history of the stock markets and just do nothing but look at the market cap composition of the broad indices, that has also changed so dramatically every 5 years. If you look at 20 years back, there was probably, or 23 years back, there was no banking in the index. Can you imagine index without banking? But there was no banks listed in 1991 in the index, so to say. So, these are things that in a dynamic economy like India, especially in emerging markets, where markets is developing, the economy is still developing, people are graduating into newer and newer consumption levels or income levels. So segments are coming up. Like, who would have thought that we would have a pizza delivery company listed with a decent market cap? Who would have thought that we would have, probably a logistics company with a, with a market cap of probably 3,000-4,000 crores listed. So, so that's the kind of growth that you see. So I would say growth is essential, and growth is available in a dynamic country like India, and one should definitely look at growth investing in India.
So if I had a lakh to invest, right, and I said that okay, 80,000 I'm going to leave it to the experts, which is I'll put it in Mihir Vora's fund, I would put it in some other mutual fund, I'd spread it and get them to invest for me, and 20,000 I want to bet on my own. What would be, and like I said, that probably invest in things which Mihir Vora, because of his constraints, cannot invest in. What should I look out for in a company? What are the things that I should look out for? Because obviously I would look at high growth, I would look at high risk, both upside and downside.
Sure. So, whether it's a 20,000 crore market cap company or a 400 crore market cap company, the approach has to remain the same. You cannot change the fundamentals to, you cannot change the parameters to kind of adjust for the size of the company. So, if in a large company you are looking at management capability and credibility, you have to look at the same in the case of the smaller company also. In a large company, if you are looking at cash flows, cash flow generation potential, capital intensity, you have to look at the same in the small company also. So I don't think the fundamental approach or the framework should change depending on the size of the company.
But then
it's just that
I wouldn't have been able to.
Advantages that
I'm saying 10 years ago, if I were in the US, I wouldn't have been able to invest in Facebook or Google because they didn't have cash flows. I didn't know about their management. In fact, whatever I would have known anecdotally about the management of Facebook, I probably wouldn't have liked.
Absolutely. So what I'm saying is that obviously you can't have one template for every sector, one template for every. Even in India, for example, there are companies which are burning cash, but which for example we do believe that will generate cash at some point in time, and of course we haven't invested in too many of those companies because so far they are being funded by mostly VC and PE kind of funding. But I'm sure very soon in the next year or two we'll have some of those companies also being listed in the local markets. So we'll have to take a call as and when it comes the next Facebook or the next Indian Facebook or whatever it is. All I'm saying is that whether it's a large company or a small company, you have to have a framework which is similar. But some of the advantages that you have in a smaller cap company is that because information or following in a small cap company is low, probably valuations are not yet fully discovered, and that's where maybe you have this advantage of not of entering into a stock before it gets too popular. Whereas in a large cap company, since it's already been covered by 10, 20, 30 analysts, most of the funds already have discovered it. The growth, even though attractive, might already have been priced in. So if you do a little bit of tire kicking yourself, a little bit of on the ground work yourself, you probably can find some stocks yourself too, I'm sure. And these days with the internet, information availability, disclosure norms, etc., is pretty high. So it may not be that difficult, but you'll have to spend time out of the studio for that.
No, we are not allowed to, unfortunately, invest because of our compliance issues. So we can only invest with people like you. But I know you said that you are going through you're betting on the domestic play, and you're trying to stay out of anything which is a global exposure, which is IT, which is pharma in terms of the big cap space. How worried are you about what is happening in, let's say, the US? As when I take Facebook, I take Google, I take Uber, I take any of these things, or even Make My Trip, when it buys IB, the stock goes up 54% on NASDAQ. From the outside, it looks like these are all companies which have very little cash flow. They're all future growth companies. They're all betting on, this almost reminds one of dot-com bubble revisiting. Does that worry you?
It does. Broadly speaking, the PE space over the last 5-7 years has grown a lot, with the large funds getting bigger and bigger. Same is the case for hedge funds, and in the peak of the valuations, we also had hedge funds putting money into private equity kind of investments. The bottom line is that this all is a function of chase for yields. With interest rates globally having come down to zero levels in so many of the developed markets, basically there is a desperate scramble for yields by investors, by pension funds, by corporates who have to fund their retirement plans, etc. So the growth of the PE industry is a function of that. So as you correctly said, it is a risk because central banks are now hinting that it's probably no longer feasible to keep cutting rates, and we need other measures to keep growth going, etc., to get inflation back. So my worry is that with interest rates now having bottomed out and gradually creeping up, valuations that we have seen in the last 2, 3, 4 years may not be sustainable. I kind of tend to agree with you.
All right, Mihir Vora, before I let you go, just to recap, give me 3 points that you think that our viewers should look out for and watch out for over the next few months, in terms of what are the key triggers that could make a difference to their portfolios, the returns on the portfolios.
Sure. So on the global front, we'll have to look at the outcome of the US elections and the outcome of the November-December meeting of the Fed, whether they end up hiking or not. The probability is more than 60% that there will be a Fed rate hike in December. So on the global front, this is the US is one thing to look at. The second thing to probably look at on the global front is what happens to the referendum in Italy. That probably again will happen in November/December. So that's another key event like the Brexit event that one needs to monitor. And on the local front, a couple of things. Let's see how the Diwali season pans out in terms of consumption, and let's see what the GST rate structure finally ends up looking like, and answers to these we'll get in the next 1 or 2 months.
All right, Mihir Vora, thank you so much for joining us. Pleasure having you, and we'll hope to get you back soon on the channel. Thanks a lot.